whenever I open my wardrobe, I see three or four shirts which are lying there, and I don't use these shirts. Like some of these, even I did not wear from last 3 years. But whenever the thought came in my mind that I should throw these, then another thought overpowers that, well, let me keep this. I'll use it sometime, and then I close the door of my wardrobe. What this has to do with why traders can't control losses? Well, I will explain everything. So stay tuned and watch this video till end. In around 2016, I have invested in Yes Bank. Yes Bank was a very good bank that time. It was commanding highest P among banks. It was valued more than HDFC Bank. Many institutions were invested in this bank, and this was a very good bank. So I was also invested, and around when I invested, price was less than 200. And I saw that within couple of years my investment was doubled. And then one fine day in 2018, somewhere in August September, the share price has fallen around 35%. That was a shock. So very next day, I before market opening, I was thinking that I will close my position, but then another thought came in my mind. I decided to buy put option, and that was my another mistake. I bought this put option, but the problem was lot size of Yes Bank was 5 times more than my holdings. So like it was like I was buying 5 times more protection for my shares. Another thing is, due to this fall, volatility has increased in this share, and its put option prices were too costly. And market opened. After some time, I bought this put option, but after some days, I observed that prices came down further, but my put option was not giving me any profits. So it was not doing its hedging work perfectly. So I decided to square it off. Fortunately, I did not lose in that put option, but I did not earn also, even though prices came down little bit, because expiry was coming next month, and this put option did not give me any profit. So I square up that put option, and I saw that it almost my profit earlier, which I was seeing as double before some months, before 1-2 months, was now like kind of no profit, no loss, some 10-15% or 20% kind of profit. And finally I sold all my shares, and then decided that I won't be investing in this bank. At the same time, one of my friend who was also invested in Yes Bank, he invested before me, but he has added more, means he doubled his position when Yes Bank was around 200, and after some time share price started going up, and I was kind of regretting that I made mistake. But then I decided that okay, I won't be investing in it again. But my friend was invested, prices were going up, he was happy, and again it started falling. It came down to 100, and then my friend also lost his patience, because his losses are like twofold now, and he has squared off his positions. Why this happens with us? Why we are unable to square up our positions in time? Why we take this such big losses? Because whenever I used to discuss with my friend that it's going down, he used to tell, और कितना गिरेगा, और इससे कितना गिरने वाला है ये, बट देयर वाज नो लिमिट. We used to discuss, he used to tell me और कितना गिरेगा, next day it will again fall. And this और कितना गिरेगा is a wrong thinking if you are a trader. Because what happens is when prices fall like this, you freeze, you can't square up your position, because human mind is not made to take losses, and this is called loss aversion. So we can't take losses happily. We want to avoid that pain always of taking losses. When we see our position in loss, we freeze. We want to maintain the status quo. The status quo which I was maintaining when I had those shirts there. I'm just thinking that okay, I'll sometime I'll use it, but I am not using it. But I am keeping those shirts in the wardrobe. This is status quo. Now, generally, what happens is this freezing. This don't happen when prices are going up. If I bought some share, its prices are going up, then our thinking is like, acha, chalo, we are getting good profit. We don't want to lose that profit. So whenever we think that now it has come up this say double, my share price is doubled, then your thinking tells you that it's double, take out profit, and you take out the profit, you book the position. That time you won't think like this. You will think that और कितना बढ़ेगा, and you close your positions. But the fact is, whatever is going up keeps going up. Whatever is keep falling keeps falling. But we conveniently forget that actually. And this is called loss aversion. When your prices are going up, we think that okay, we are in profit, so we don't want to take loss, and we close our position. But when we are in loss, when prices are falling, we think that और कितना गिरेगा, because we don't want to book that loss. Now I'll tell you a simple example. Let's imagine you gave me 100 rupees and I gave you two options. Either take this 150 rupees from me directly. You gave me 100 rupees and I am giving you back 150 rupees. So take this 150 rupees, or take this coin. You have to flip the coin. If it is head, I will give you 200 rupees. If it is tail, you will get only 50 rupees. So you will lose 100 rupees. Okay. So if it is head, instead of 150 rupees in first option, I will give you 200 rupees. And if you lose, I will give you only 50 rupees. Or say 100 rupees as it is. I will return your 100 rupees as it is. What you will prefer? Most of the people will prefer 100 rupees certainty. 150 rupees. First option. Because 50 rupees they are definitely getting, right? They give me 100 rupees, they are 100% getting 50 rupees extra. So 150 rupees was first option. Fix, they will prefer it. They won't flip the coin, even if they have opportunity to get 50 rupees more. No. Why? because here they are getting fixed 50 rupees profit. But take the opposite scenario. You give me 100 rupees. I offer you, take this 50 rupees back. Okay, you are losing 50 rupees in this option, first option. Or second option is, flip this coin. If it is head, I will give you 100 rupees back. If it is tail, you won't get anything back. This is second option. First option is certainty that you lose 50 rupees 100% because I am giving you only 50 rupees back. Second option, you have chance to win back your 100 rupees if you flip the coin and head comes. If tail comes, you lose that 50 also. But in this case, most of the people prefer to go for coin flipping. Why this? In first case, people took the 50 rupees certain profit, but in second case, they did not took 50 rupees loss. They preferred to toss that coin, right? Because it means they bet this remaining 50 rupees also. Why? This is an experiment, and many people did similar experiments and proven that people don't want to accept the losses. That's why they keep on betting more. In casino also, who play in casino for a long time, those who are losing, they lose and then they play for recovering that money, because mind cannot accept losses. If they come out of casino, they will feel good actually, that okay, whatever I lost and now I won't lose anymore. But if they are inside casino, their mind will tell them that you lost. If you go out from here, then chance of recovering is gone. Chance of recovering this money is gone. So this risk aversion make these people to lose more. Now, this what I am explaining you is called risk aversion. This is a term in psychology, which is a very important term. Means our mind is made to save ourselves from losses. This is very good. This is a survival instinct actually, because our generations have survived because they don't wanted to take losses. So this is a very good trait actually, but not in monetary endeavors or in trading. That's why traders lose. Next thing is, when the prices of certain share come down, we don't want to sell this because we are reluctant to sell this. Why? This Yes Bank price came down from say 350 till 200. Why my mind tell me is that okay, it has fallen, but it will again go up. If I sell, I lose that chance of recovering my money, and my mind keep telling me that you will regret later because it will go up. If you book the loss, your chance of recovering this money is gone. This happens even if the share of 400 rupees go to 40 rupees. People think that okay, let me be in there, let me not book the loss, because sometime it will go up and it will give me my money back. This is called disposition effect. So and it is observed in many cases. People are reluctant to sell the assets which already lost their value, or their value is the asset is losing its value rapidly, and people are like reluctant to sell this asset because they fear that they will regret it later, because its value will go up, and that time I will regret. Now the same thing happened with my clothes, right? I assign some value to them, even those are useless. If I am not using those for 2-3 years anyway, there is very less probability and less chance that I will use this in future, because there is some reasons I am not using this, right? But I am still keeping those in that wardrobe, because even if some asset has lost its value, but you owned it, then you value it more, because you just you own it, you value it more. And in stock market this happens quite frequently, that people value their shares more than actual what is their price in the market, just because they owned it. That I am having these shares from last 10 years. It is very good company, so I have it, so its value is more. Even if it's falling, they are unable to sell it, because they think that I own it, so its value is more. So this is called endowment effect, where you value some asset more just because you own it. Just there are some emotions attached to it, so you value it more. Just take an example. You buy some gold, but you buy it in form of ornaments, and your wife or mother, somebody has used these ornaments. Now you have your emotional investment also in this. You value this more. You value this gold more. Now even if gold price is increased and you need money, you have no money, then you will better go and take loan. You will go and take a personal loan or something, instead of selling this ornament, even if you don't need this, because you have attached some value. You value these assets more than its actual value, just because you own it, or you have some emotions, right? This is again the kind of extension of endowment effect. Well, let's come back to share market and trading. So how to avoid it? Because these concepts, whatever I told you yet, loss aversion, endowment effect, disposition effect, these are psychological things. These are proven things, and many people, psychologists, proved these by different experiments. There are many white papers on this, and these make traders lose. Means now we know that there are some psychological things which avoid us, which don't let us book the losses. But then how to save ourselves from these? There are very simple things to do, and if you are not doing this, start doing this right now. That for any of your position or holding, create the exit criteria. You should have a proper exit criteria. In what condition I will sell my holdings? In what condition I will square up my positions? That can be anything. It can be in percentage terms, that if prices come down, say 20%, I will, from its top, I will sell my holdings. Or it is based on swings, like prices move up or down in swings, right? So if price come below previous swing low, I will close my position or I will sell my holding. Or those can even be exit criteria can be based on fundamentals also. That if its P ratio crosses this, then I will sell based on valuations. Or you can create your own metrics, and but you have to create well defined rule based exit criteria, which you should always use. Whenever your exit criteria satisfies, you should close your positions. This is the only thing which you can save you from losses, because then your this loss aversion won't impact you. Your mind won't tell you that और कितना गिरेगा, because when you put your mind in habit that when this condition has come, I have to exit whatever happens, then this mind will never ask you और कितना गिरेगा. Okay, so use stop losses. See, in trading, those are 100% essential. Without stop losses, if you trade, you will lose all your capital today or tomorrow. Means one day you will lose all your capital. But even if you are an investor, you should have some exit criteria, and you should exit your positions based on that criteria. That criteria may be based on technicals, or it may be based on fundamentals or valuation, if its valuation is too high or it's something else, whatever. But there should be some well defined exit criteria. So that was the message from this video, and if you liked it, then please share this video with your friends. Also subscribe to the this channel so that you will get notification whenever I post new video. Also like this video, and if you have any questions, comment on this video. So that's it for now. Thank you very much and goodbye.